The stock market has been an absolute tear over the past couple of months. And look, I have benefited from it too. The asymmetric portfolio is up 27% so far this year. But that doesn't mean that the market isn't getting overvalued, especially as some of the most speculative stocks on the market are soaring. AST Space Mobile, Oklo, New Scale Power, Tempest AI, even Groupon are all up over 100%, despite the fact that they don't make money. SPACs are back. Recession fears appear to be completely gone. If this sounds like the market in 2021, it's because it feels very similar. Greed is the name of the game on Wall Street today, and that's the time that we want to be a little bit more cautious as investors. History says that crashes happen pretty frequently. There are typically drawdowns of 20 to 30% about every decade. From 20 to 2022, there was a huge pullback in the market. 2007 to 2009, the Great Recession. 2020 was actually an outlier because it was very short-lived and markets went on to hit new highs. So I think we're actually due for a big pullback. And this is something investors need to be aware of, even if you're fully invested in the market like I am, even if you're bullish on the future, even if you want to buy great growth stocks. Being aware of the downside risk is key for investors. So that's what I want to dig into today. What should we be watching for the potential downside of the market? My name is Travis Hoium. Thanks for watching Asymmetric Investing. And if you're not already, please subscribe to Asymmetric Investing, my newsletter. That's where you're going to get all of my research, my deep dives on companies, and my market-beating portfolio. You will see every single stock that I buy every month. Before I buy them, I tell my readers exactly what I'm doing, including some potential short positions that I'm considering as the market gets a little bit more frothy. I also want to thank this video sponsor, Fiscal.ai. You're going to see Fiscal throughout this video. This is the best research tool that's available today. They have all of the financials that you need: income statements, balance sheets, cash flow statements. They have transcripts. You can interact with those transcripts through artificial intelligence. Just ask questions about what happened in the quarter and what management is saying. But the thing that I love is their key performance indicators, or KPIs. You can look at how many deliveries did Tesla have last quarter? How many subscribers does Hims and Hers have? All of these things are things I used to track in spreadsheets. Now they're all available on Fiscal AI. If you want to check it out, you can do that for free. You'll get the pro version for 2 weeks if you go to fiscal.ai/ASYM. If you like what you see, you get 15% off with that link. So check that out. That's a product that I pay for. So put my money where my mouth is there. There are 5 reasons that I think the market could potentially crash or have a big pullback in 2025. The first reason that I want to highlight is just simply the multiples that the market is trading for right now. This is a chart that I like to go back to periodically. This is from multiple.com. And you can see the price to earnings multiple of the S&P 500 overall since the 1870s. So this is a long history. You can see that the multiple was never over 30 until 1998. That's pertinent because 2001 through 2003 was one of the biggest crashes that we've had on the market and a long duration sell-off. So you can see that that multiple actually popped up because earnings dropped in 2021. That causes your price to earnings multiple to go up. So actually peaked again, but dropped by 2006 down to about 17. So a much more reasonable multiple down in 2006. But then you had the great financial crisis and companies started losing money. This just kind of goes off the charts. And that's again because the earnings part of the PE multiple was absolutely decimated. But by 2010, we're back to a PE multiple of about 15 or 16 for the entire market. 2011, that multiple goes down to 14. So having a PE multiple of 14, not all that unusual for the market if you look back historically. What is unusual is to be at a PE multiple of 28.55 like we are right now. Yes, that multiple did go above 30 in 2020 late in the year. Again, earnings dropped. And by the end of 2020, the market had recovered all those early losses from early in the pandemic. But we're in a pretty normal period right now in the market. Earnings are very strong, but prices are even stronger. So that's a big warning sign that if things do start to pull back and we go back to, let's say, a price to earnings multiple that's more normal here of maybe 16 to 20, that would be a 30% pullback in the market. One of the reasons for concern is just the treasury yields, and yields overall are rising. This is the 20-year treasury yield. You can see that a year ago, the yield was about 4.5%. Now that's up to 4.9%. So it's more expensive to borrow money. The 10-year yield, not up quite as much, but is still about 4.4%. On the corporate side, those interest rates continue rising as well. This is from the Federal Reserve of St. Louis. And you can see that interest rates on AAA loans, corporate bonds, have gone from 2.4% in 2020, middle of 2020, to 5.5% today. So rising rates should mean that investors are demanding more from the companies that they own. Those price to earnings multiples should come down. But the opposite has happened. Price to earnings multiples are going up as interest yields are going up. Keep in mind that the bond market is 10 times the size of the equity market. If bond investors are demanding more yield for taking any risk, that means that their worry or their concern is going up. Equity investors have not priced that into the market, and I think that will eventually happen. Another thing we're seeing is a slowdown in housing. Housing is a huge driver of the market, so this is something that we need to keep an eye on. But the time that it takes to sell homes is up. Values are starting to fall in some places. Supply is exceeding demand. And here are some of the keys. Builder confidence is down. Not only is the home builder sentiment index down, but the number of permits that they're taking out to build homes is down. A reduction in both of those things typically ultimately leads to a recession. And that's because housing drives the economy. It drives commodity purchases. It drives auto sales, given how many people are working in that market. It drives the banking industry and the volume of loans. So much is downstream of housing. It was housing that drove the 2008 collapse of the economy and the financial markets, and a decline in housing today could set us on a course for a correction. I'm not predicting a collapse, but a correction in the market over the next year or two. Fourth, we have the topic that everyone's talking about, tariffs. Now, frankly, we don't know exactly what the impact of tariffs is going to be, but it is likely that we're going to see higher prices for items, particularly later this year as we go into the holiday season, as all the inventory that was bought ahead of those tariffs moves out of the system. That's going to lead to higher inflation. Typically, to fight inflation, that means higher interest rates. This is one of the reasons that the Federal Reserve is not cutting rates right now. Now, there may be positives from tariffs as well. There may be more employment in the US. There may be higher wages. We are not going to see the full impact of most of these tariffs until at least the holiday season of 2025. But that's why this year is going to be such a big year for the market, because we're going to be absorbing those higher interest rates and tariffs into the economy. And that brings a lot of uncertainty to the market. The fifth thing that I'm keeping an eye on is student loan repayments. This has been something that has been put on hold for most of the last 5 years. And if you thought consumer spending was weak before 2025, then it's probably going to get worse as people with billions of dollars of student loan debt have to start repaying that debt, and it starts to hit their credit scores. We are already seeing credit start to freeze for some of these buyers. Wages are potentially going to be garnished. This is money that was once put back into the economy, and it's now going to have to go to simply paying back student loans. So that's a big risk for the market, and we as investors need to be prepared. There's a few things that I'm doing, and I'm reinforcing week after week on asymmetric investing to prepare for a potential downturn. One thing is I'm not investing in those speculative stocks, those companies that haven't proven the ability to grow sustainably or to generate a profit long term. If you look at something like the Gartner hype cycle, I don't want to be investing at the peak of inflated expectations. I want to be buying stocks at the trough of disillusionment. So some of these companies that have been highly hyped over the past couple of years may be phenomenal investments long term. But if the hype bubble pops, they will also drop significantly, potentially 80, 90%. Even phenomenal investments over the past couple of years, like Robinhood, like Coinbase, like Hims and Hers, all dropped 80 or 90% from their peak in 2021, 2022. That was not the time to buy. That was the time to be patient and wait for those prices to come down. I want to do the same thing again this time around. I'm also looking to buy companies with more value, companies that are profitable, that are generating cash, that trade for reasonable multiples. MGM Resorts is one that I think trades for a very low multiple. Management is buying back about 15% of their shares outstanding each year with the cash that they're generating, and there's growth on the horizon. Lyft is generating positive free cash flow, just announced a huge buyback program, and they're trading for about a quarter of the price of Uber. I'm looking for great balance sheets. Alphabet has a phenomenal vet balance sheet and a price to earnings multiple that's lower than its Mag 7 peers. I want companies with pricing power. On Holding said that, you know what, tariffs are going to lead to us just raising prices because we can do that. We have that kind of power in the market. So I'm looking for companies where the numbers back up what the story is as well. Story stocks are great, and that's a great place to start research. But as we get more highly valued in the market, these story stocks are not the ones that I want to buy. I want to buy the companies with phenomenal numbers where the story will follow in subsequent years. Because if the market does collapse 30%, you want to have that cushion of fundamentals to fall back on. So none of us can predict exactly what's going to happen, but I think there's a large possibility that the market is going to have a big pullback over the next year or so, potentially as much as 30%. And that would just get that price to earnings multiple back to a more normalized level. Now, through all of this, I'm going to be investing every single month. I'm going to stay fully invested in the market. So if you want to find out what I'm buying every month, subscribe to Asymmetric Investing. For just $100 a year, you get all of my deep dives, all of my portfolio moves. And by the way, that portfolio is beating the market by a wide margin, not only in 2025, but since it began. So there's a link on the screen and a link in the show notes if you want to check that out. Join that community. And let's beat the market by buying phenomenal companies that can 10x over the next 10 years, rather than speculating on stocks that may only be hot for the next few weeks. Now, let me know what you think about the market today. Leave your comments in the comment section below. And of course, subscribe here on YouTube. Thanks for watching, everybody. See you here next time.